Welcome to This Week in Money. I'm Jim Goddard. Today, Bob Hoye from chartsandmarkets.com runs down the major markets. Once again, new highs were recorded on the New York exchanges. Bob takes a close look at the U.S. and Canadian dollars, crude, copper, credit spreads, and gold. Plus, Bob will be here to look at some interesting business headlines that caught his eye this week, along with the answers to several listener questions on subjects like the U.S. Fed, inflation, and interest rates. Author of several books on the economy, including The Money Bubble, John Rubino, will comment on dumb money, pension funds, gold, silver, lithium, cobalt, and cryptocurrencies. At the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Bob Hoye, Chief Market Historian and Investment Strategist for chartsandmarkets.com. He's filling in for our regular guest, Ross Clark. Bob, we saw record highs again on the major stock exchanges in New York this week.
Yeah, the senior indexes, the S&P, important representative index, new high, like barely. The old Dow Jones, new high, and then the NASDAQ, a new high. But we see that the transportation index is nowhere near new highs, and it's worth mentioning the transports because that goes back to 100 years ago with the Dow theory is that on a bull market, the transportations always have to confirm what the Dow industrials are doing. And then when you're at the top of a market, where we may be now, they get a negative divergence with the transports making lows as the Dow industrials make highs. So there's nothing screaming about this now, but it's sort of a let's mention it kind of thing that there's a divergence here. But yes, senior index is making new highs.
Bob, you've told us in the past to keep an eye on the transports because they're usually the first hint of a down market.
Yeah, we watch them, and this has been, they set their high in early May and have set a series of lows all the way since to this recently when the Dow Jones industrials have made new highs. So yeah, that's a divergence that is worth watching.
What's going on with the U.S. dollar?
Hey, the thing has been basing. And what got our attention on that, Jim, was in January, the sell-off was very severe and became oversold enough that it was, hey, let's take a look at this and see if it can build a base. Now, the base is built by, sideways trading and typically it's about 4.5 months. And this one ran for 6 months. Now, how we tell that the base completes is that there's kind of a handy moving average. It's the 20-week exponential moving average, and we found that it works. So, a couple of months ago, the DX, which represents the dollar, rose above its 20-week moving average. So that completes the base building. Then the next step is to take out an interim low, which was the 93 level. And this week it's been working on that. It hasn't broken out yet. But when it does, it can anticipate some problems in the overall financial markets. When the dollar index goes down, time is on, and then when we find the severe corrections come in, the dollar index goes up a little.
Anything going on with the Canadian buck?
Well, it reached a terrific momentum high a number of weeks ago and has been drifting down. That high was also close to when industrial commodities had their highs. So we took it at the time as the Canadian dollar fulfilling its role as a commodity index. And there's a certain amount of irony here because the federal government is out to end resource development and resource shipments in Canada. So without producing commodities, you won't be able to call it a commodity index currency anymore. So, but the latter part, I'm just being a bit frivolous on that, Jim.
Yeah, take away the thing Canada does best, natural resource development. Yeah. What's going on with crude?
Oh, my gosh. That one, it was fantastic in 2020, into March, when it had the COVID crisis in the financial markets, where actually the nearby contract went to minus 35 or minus 40 or something, which was a complexity of the outgoing contract. But I think you can say the low might have been 6.5 on one chart I look at. And then it rallied, and then it churned around for a while. Then a few weeks ago got up to 77. Pretty good rally, from which it's been correcting now. Now, our view on this one is that most of the industrial commodities would be strong with the stock market into around mid-year. And they have been. And what we're seeing now is a bit of a change coming in on things that were supporting the stock market. As we said, the senior index is making new highs. But supporting items have been strong commodities. And the credit spreads, which is the difference between high-grade and low-grade bonds. And in the good times, with confidence, the spreads narrow, which they did into, let's just say into June. And then as of this week, credit spreads have reversed to widening, and that is an alert on the party that's going on in the stock market. So we'll watch that one very closely.
What kind of a prognosis are we getting from Dr. Copper?
Oh, boy, what a terrific rally at 489 in May. Then it backed off, and then we noted that for copper, you can have a sort of a secondary seasonal rally into July, which we're getting, but it's looking a little weak. So my view is that, when August came, and it's here now, the view was that the seasonality for these major commodities would have been, their best would have been met, and we've had that with lumber, perhaps copper now, perhaps crude oil. But anyways, in August on our schedule was we start to look for seasonal weakness in these important commodities, and lumber can set a seasonal low in October, copper in November, and crude oil in January, February. So we've had seasonal strength approximately when it was likely, and this seems to be topping. And then now it is the careful thing to look and review the seasonal weakness that we can get later in the year. And then also with these things, as I've said, industrial commodities rallying has been very supportive for the stock market. And also there's a link between commodity prices and S&P earnings. When commodity prices go down, it sort of represents purchasing power of businesses and what they can get for their products and stuff. So then earnings may become vulnerable after August. And then that gets you to junk bonds, because you have to have good earnings coverage to pay for those high interest rates in junk bonds. And if the earnings are starting to fade, then that'll show up in junk bonds. And as we've noted, the credit spreads, junk and treasuries, have already reversed towards adversity. So it looks like we're in a period of transition here.
What's going on with gold?
Oh, stumbling around because there's a great many players out there position gold based upon what the U.S. dollar does, because that's the price. That's the nominal price for it. And it was sold off here today. It's nothing too exciting in the gold market, despite all the noise about inflation coming back. This tempers my view on inflation coming back. I think this is just a boom in commodities that you're getting with the business boom that goes with the final leg of a great financial bubble. So all of which this could peak in the next month or so and then roll over. So the gold, in the long run, one wants to look at the real price of gold, which is relative to the CPI inflation. And we found that when gold's real price goes up, profitability for gold mining improves. So what's going to happen here is that if we go into financial crisis, gold's real price can go up, which will eventually enhance their operations. But the problem is, if we get into a financial crisis, gold stocks will go down. So we've had, while gold stocks reached a terrific technical readings in July a year ago, and which case our advice was to take money off the table. And then what we're looking for now is no rallies, but weakness probable, and maybe into November, when our technical research will likely give us a good buy on an opportunity there. So and then silver. I actually looked at silver here just a few minutes ago, and its recent decline is to a new low from the May high. Just barely, we shouldn't quite know. But what is of interest is that the gold-silver ratio, gold divided by silver, and in a party time, it goes down, and it went down until a few months ago, and then in a post-party time, the gold-silver ratio goes up. So it's sitting here ready to break out. And if the gold-silver ratio goes up a little more, then that would mean silver performing poorly relative to gold some more, then it would be signaling a possible credit crisis later in the fall. So there's another one of our items we watch, is the gold-silver ratio.
More with Bob Hoye, including answers to listener questions, right after this.
Always consult your investment professional before making any investment decision.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com in Vancouver. Bob, as regular listeners of your show on Howe Street know, you love to answer listener questions. So our first one comes from Greg. Greg writes, since the United States is printing money like crazy relative to Canada, how come the Canadian dollar is not strengthening against the U.S. dollar?
Well, Greg, that's a difficult question because I don't have the numbers in front of me about printing money. And then the other thing about even if you had the numbers in front of you, that's sort of cause and effect thinking. And massive arbitrary expansion of credit that the Fed is now doing, it may be being undone by the velocity of money contracting. So, and Canada's for a strong currency until a month or so ago was, of course, based on the fact that it was a commodity currency, despite the fact that the federal government is trying to shut down all commodity mining and transport. So, but it still behaves like a commodity currency. So it peaked with some of the key industrial commodities and has come down. And we've got that last sick low at 68 as the target. So, yeah, not much hope for the Canadian dollar.
From Justin in Berkeley, California, everyone is citing supply chain issues as a reason to increase prices or reduce a product size. I sort of remember De Beers monopolizing a relatively common object like diamonds and creating a supply squeeze market that they can control. I have a suspicion that across the industrial world, if you want to collude and raise prices, you just use those magic words now, supply chain, abracadabra. Jim always cites the refinery fires that pop up before the summer gas blend is introduced. It's true. Most springs we always have a refinery explosion or fire, but this time, of course, it's supply chain issues, computer chips. Is inflation hysteria-based supply manipulation, and does it have anything to do with money supply?
Oh boy, what a good one, Justin. We're taking this as this year, 2021, counts out to be the most likely year for the greatest financial bubble in history to complete. And with that, you've got showing up over the last many months, a surge in business. And I'm taking that as the surge in business you get with the final leg of the stock market in a great bubble. The unusual thing, of course, was the COVID shutdown, and that was quite relentless and unusual. But the boom is still here. So, and of course, there now a whole lot of people are getting on the bandwagon and saying this is going to get inflation like the 1970s. But I'm staying with our research that the inflation has been in financial assets to a degree never seen in history. And when the great financial bubbles fail, they've always been accompanied by a long contraction with pricing pressures on most assets. And with the boom this year, it was likely, looking at the senior indexes, to reach its best by about mid-round now or whatever, and that we're getting that. But now also, when I wrote yesterday's piece, there are some important elements that are beginning to change. Industrial commodities got hit pretty hard. The credit spread, the difference between high-grade and low-grade bonds, they would have acted well into about mid-year, and they have. But now they're beginning to change trend. So it looks like the climax for the boom was accomplished at about the right time, and now there are adversities coming in, and it looks like we're going to get price deflation in most items.
Our question from Sam. Thanks for your research, Mr. Hoye. What are some great reads on your markets and cycles that you have on your bookshelves and that you'd recommend to people?
Yeah, I grabbed a couple of books here. One of them is Money of the Mind by James Grant. That's at Grant's Interest Rate Advisor. And then the other one is specifically on the 1929 bubble and crash. It's called The Day the Bubble Burst by Gordon Thomas and Max Morgan Witz. So there's a couple to keep you busy. I mean, you might be able to find them at the library because these are now older books. So, yeah, worth a try. Thanks.
From Henry Solomon, Hello, Jim and Bob. If the world's major economies experienced deflation in the autumn of 2021, how would that affect U.S. government bond and note prices?
Yeah, on the long treasuries, and a couple of months ago, they became the most oversold on a chart back to the early 1980s. So we just had to recommend the buy on them, and that was at the low was around 154 on the bond future, and it rallied to 166 recently where it got overbought, so sideways for a while. Yeah, you've got the if this great speculation begins to fail, there'll be another leg up in the long treasury or in the bond future, and it would be, ironically, the safe haven trade, and then it'd get excited and become overbought. But yeah, the high grade bond market could extend its rally. Low grade bonds can go no bid, maybe some months from now. So it's going to be one of those credit quality items. But Henry, thanks for your question.
Bob, a listener comment. In October 2008, Alan Greenspan, who in a display of helplessness, having raised, lowered interest rates in an attempt to stave off the financial crisis of the day, had to admit in front of Congress that his ideology was not right and that his models were flawed. Given the CDC's recent flip-flop on face masks for all, including vaccinated individuals, how long might it take for Fauci and company to follow in Greenspan's footsteps? It seems mask mandates, vaccines, and curfews are the useless tools of the fascists who like CO2 certificates for the followers of greenism, or interest rates and QE for the Keynesians to achieve balance in their fantasy worlds. Bob, how can we get these people back into reality?
Good. The last one's a good one. A great financial mania is a time of delusional optimism. But also, I've noticed, and I'm starting to write an article on it, is that these wild periods in politics can be accompanied by very wild periods action in the financial markets. So, in the early 1900s to 1920, wild financial markets that also included the U.S. going left like you wouldn't believe, and the federal government nationalizing railroads. And then after the First World War was over, they thought, oh, why did we nationalize the railroads? So they privatized them. But in Russia, of course, you went the full yard with the communist revolution. And but they backed off in 1920 when that commodity boom was over. The politics around the world shifted away from authoritarian and back from that. And as I said, the federal government in the U.S. started privatizing the railroads they'd bought. And then in Russia, even the Soviet Union, it backed off from extremely hard communism with no price calculation into some sort of a softer socialism with some price calculation. So this is probable in our absolutely wild politics and wild financial speculation is that both can deflate together. And to go back to your start of the question about Greenspan and his policy twists and turns, he had been a strong, shall we say, conservative economist as a younger man and knew that the world is a happier place when you have the currency convertible into gold. So he was a sound money man, but there were times when he was chairman of the Fed. There were times, of course, when it wasn't Alan Greenspan speaking, it was the chair of the Fed speaking. The public man has to say certain things. And then the other part was there were times when I thought, oh, he's trying to blow up the whole Federal Reserve System to prove that it didn't work. Well, they still believe in it. Maybe the next contraction will finally persuade enough people to say that the intrusive central banking is a disaster, and I think there will be academic economists that will criticize the Fed's blunders, and they're also even more concerning will be that the public opinion can turn against them for spending trillions of dollars trying to keep a financial bubble going. So next few months are going to be very interesting.
Bob, the Fed and the Bank of Canada have said they're going to try to keep interest rates low for as long as possible. But the last time we had rampant inflation back in the late 70s, early 80s, when interest rates were going up to 21%, that was seen as one of the solutions to the rampant inflation then. That doesn't seem to be a solution being batted around right now. What's the difference?
That one was you were in the time when the public chose to speculate in tangible assets, and it was also a time in a secular rise in long interest rates, short ones as well. And you got to go. There's a huge irony here, Jim, because in 1946, at the end of the war, the U.S. was saddled with an immense debt problem, but that was at a secular trough for interest rates. I think, let's say long end got down to 2.5% yield. And then yield started to rise so that they're approaching 3%. It was even possible for politicians to calculate that increased the cost of debt servicing by that much. So they came up with a brilliant idea that the Fed would buy bonds out of the market, and by buying bonds out of the market, that would prevent interest rates from rising above 3%. And then you get into the mid-1960s, and then the yield was then, let's say, it was about 6%, obviously not working. So then the policymakers got all more excited about it, and they based an operation, they called it Operation Twist, based upon a popular dance hit by Chubby Checkers. And an Operation Twist, well, it was buying bonds out of the market to keep interest rates from going up. But they just didn't understand that the injection of all that credit into the system was cranking up prices then in tangible assets, which was raising the rate of inflation. So the nominal rate of interest on the long bonds went up. So it was the Fed's determination to lower interest rates that actually raised interest rates. So we'll just see here now, of course, they're trying to inflate everything. And it looks like with the boom, so far it's working, but as I've said earlier, the boom is beginning to falter. So then it will look like they blew it again when you get into the next phase of heavy liquidation in the financial markets. So, but it's fascinating to watch. But as I said, at times I thought Greenspan was out to deliberately blow up the Fed, and nobody is deliberately trying to do that now. They're all too stupid, and they really think they're going to save society by creating credit. So it's going to be interesting, Jim.
Some of the headlines that caught your attention before the show: why a looming copper shortage has big consequences. What's the story there, Bob?
Oh, the headline is copper shortages, and copper's had a very good rally into May, and then it backed off, and that's when we noted that copper can have a secondary seasonal rally into July, which we're getting, but it kind of looks like it's beginning to run out a bit of power here. And then, but hey, these are great headlines.
Well, I mean, with this big drive for electric vehicles, the average electric car uses 300 pounds of copper, 136 kilos. Millions and millions of cars are produced every year. How is that going to affect copper supplies?
Oh, but I know guys, decades ago when I got my first account was Cominco, the huge mining company, and Placer. And they were producing copper as well. And some wise guys there, and they said, look, no matter how new things are, there will always be a new use for copper. But but we've seen that now for 40 years. in my business, and what happens is that there's still the business and credit cycle. So it looks to me like these hot metal prices now are about to roll over and die on a seasonal basis. So we'll see how it goes.
U.S. banks are literally begging Americans to take out loans and max out their credit cards.
Well, isn't that amazing? In the height of a boom, they want to increase their business loan activities and make more money. But it reminds of the very old saying that bankers love to give you umbrellas in sunny, good weather, and at the hint of a rain, they will call all the umbrellas in. And I believe the same thing will happen here. It's just as I said, this is wild financial markets, and the bankers are acting in a wild manner as part of the play. So, be interesting to see how it turns out.
Headline: Stock analysts buy ratings reach 18-year high in earnings estimates.
Yeah, we're into what they call the earnings season. I kind of think it goes on all year round. And they buy recommendations based on earnings projections, the highest in 18 years. That's really something, because it was 1999, 2000, when all of the brokerage firms and all of the analysts within the brokerage firms were all universally bullish on the stock market. And it was amazing. It was actually after the dot-com crash, there were congressional hearings about this, and they then said that it's ridiculous that 100% of the advisors were bullish, and then they called for independent research, independent from the brokers and independent from the underwriting departments. And of course, this is with our group. This was very constructive for our business to have research that was independent of a broker or independent of an underwriter. I mean, you're in the research department of a big underwriting firm. How can you actually criticize a stock that your company just underwrote? So there's a lot of, but actually in a great bubble, there's the tendency is everybody gets universally bullish right at the top, so which seems to be happening now.
Headline: Soaring aluminum prices drive up costs from beer to foil.
Yeah. Well, that's the headline: soaring aluminum prices, and that would raise the price for any aluminum can, pop cans or beer cans or seltzer cans or whatever. And it's just, again, a terrific headline demonstrating what's going on now.
Now, we know aluminum can be used to conduct electricity like copper. The problem is aluminum becomes brittle and you're more likely to get a short circuit, especially in something that bounces around like a car. So is there really any alternative to copper? Because we were talking about that earlier. Could aluminum or something else be used?
Oh, yeah. I think on high-tension wires they've tried aluminum, and somehow the current is carried in the field around the aluminum, whereas with copper, it's a very good conductor, and it will always be needed, and there will be always new things for copper to be applied to. But it's like anything else; it's a very cyclical price for base metals, and they're high at about the right time, and beginning to falter. So, again, the headlines are showing the most obvious thing, but the reversal hasn't quite come in yet. But you've got seasonals, as I said, copper's on a seasonal rally, usually into July, and we're getting a nice rally. And then you have to look at the seasonal low, usually in November. And then lumber had the most fabulous rally you can imagine. And its typical seasonal high is in June. Well, it was in the middle of May, close enough. And then you have a low for lumber typically in October. And then the other one where you can get a low is for crude oil. And that typically can be in January, February. And it had the good rush recently to about 77 for crude oil. It became overbought, and it's getting hit quite noticeably here in the last few weeks. And the way I've been handling it, Jim, is that the seasonals for crude oil through the summer months are not as reliable as they were about 20 years ago. So I just said it'll run until it gets overbought, which it did, and then said that it's after September when crude oil can hit down, and seasonal lows for crude oil have been fairly consistent, and that's where we're looking for a dismal low in January, February. And, it's going to be a very interesting last half to the year, Jim.
Bob, thank you so much for being on This Week in Money.
Well, good to be with you, and look forward to the next opportunity.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He was speaking to us from Vancouver. Coming up, John Rubino, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to This Week in Money.
Hey, Jim.
John, U.S. stocks are at record highs despite all the risks. Why do you think investors are so optimistic?
Boy, I don't know. I'm starting a series on dollarcollapse.com titled, Why Aren't We More Worried About? And then, fill in the blank. Because there are all these things that are just, very big risks out there, such that you really shouldn't be that optimistic about equities. Among the things that could go wrong, well, it's just such a long list. We can talk about them, as we come to them in this interview. But basically, I think people are just being deluged with easy money from the Federal Reserve and from the world's other central banks, and that money has to go somewhere. So a lot of it's going into equities. But I'll tell you what, there's a shift going on right now, which should be pretty scary for equity investors. But of course, as we already established, nothing scares them anymore. But retail investors have gone all in just lately. Regular people who stayed out of the stock market for most of the past 10 years have now jumped in with both feet. So you see margin debt through the roof, and the Reddit, Robinhood traders are pouring money into the market. And besides retail, there's another class of suddenly dumb money that I think deserves mention here. And that is investment banks and pension funds that are jumping into Silicon Valley venture capital. They have poured so much money into Silicon Valley in the last couple of years that they've swamped the traditional VCs and sent the value of non-public but promising companies through the roof. Back in the days of the unicorns, which were private companies with no revenues that were worth more than $1 billion, that was a pretty notable thing. But now they're everywhere because these giant funds with tons of money at their disposal and very little historical perspective on what happens in that segment of the market are pouring money in. So, we're seeing a lot of extremely risky behavior out there at a time when the markets are at all-time highs. So I think, when you ask me why are stocks so high, the answer is they really shouldn't be. People shouldn't be buying them at this point, but yet they are.
And of course, we have so many stocks of major companies that haven't made a penny, like Tesla. Will Tesla ever make money?
Tesla actually had their first quarter ever of making money from selling cars.
Oh.
But it's still not nearly enough to make their current market valuation reasonable, because they made like $1 billion in the last quarter. Not all of it was from selling cars, but let's say that $1 billion was from selling cars. Well, that's $4 billion annualized, right? But their market cap is $700 and some billion. So that's what is that? That's a PE ratio of 200 plus. When they're still a growth company, but they're pretty mature now in a lot of ways. I mean, they've been around for a while. They're a well-known brand. They've got massive competition, so they're not going to grow by multiples of the previous year going forward. That's not possible in a market where they're competing head-to-head with Porsche and Mercedes and Toyota and Lexus and Ford and GM. Everybody's bringing out electric cars, and VW has, I think, the best-selling electric car in Europe already. So anyhow, you can say the same thing about most other big companies with high market caps, that they're good companies. They're successful at what they do, but they're valued way out of proportion to any kind of cash flow that they're likely to generate within the remaining lifespan of, the average 40-year-old. A market that depends on those stocks is a market that's headed for a gigantic crash at some point out there in the future.
Plus, with EVs, lack of infrastructure to support them. During the last long weekend here, I heard that Teslas were waiting 2.5-3 hours to just get hooked up to a charging station along the Trans-Canada Highway.
Well, see, that's a thing that's real. I mean, there are limitations on how fast the electric car market can grow, and charging infrastructure is one. The metals that are needed for lithium-ion batteries is another. There aren't nearly enough mines operating right now to take the electric car market from today to where it's supposed to be in 2030. So, they've got these limitations on growth, yes. Although, electric cars are the future. They're just much more fun to drive, and in a lot of ways, much better than internal combustion engines. So there's no doubt that this is a growth market that will continue to see really good sales overall. But it's also a really competitive market. You can't have one company dominate a market that has so many really high-powered players in it. So it's going to be extremely competitive, which means it's going to be hard to make money doing it. It'd be like the solar panel market, where there are a lot of companies growing really quickly by selling solar panels, but there are very few that are making serious money because all that competition keeps prices low. It'll be the same thing with electric cars, and because of that, the reasonable valuation in the auto market is what Toyota or GM have, not what Tesla has.
The gold and silver miners are releasing generally strong earnings reports. Can we assume they'll continue to do well?
Yeah, as long as gold and silver stay kind of sort of in their current place, the miners should just do great, because they make pretty good money with, say, $1,800 gold, $1,800 US dollar gold, which means they generate plenty of cash flow, which allows them to do a lot of positive things. Even if their earnings don't grow, if they've got a lot of cash flow coming in, they can pay down debt, which raises their net earnings, even if not their operating earnings. They can raise their dividend, which makes their stock price more attractive, which makes it easier to raise money via the equity market. They can do a lot of good things, and they can go out and buy new reserves. And I think that's the real story. Well, the lesser stories in the gold and silver mining market are rising dividends and improving financials. And those are real. Those are good stories. If you just had that, they would still be buys, most of the stocks, because a rising dividend is a really attractive thing in zero interest rate world. But the big story out there, I think, is what else they're going to do with their free cash flow, which is to go out and buy the juniors. I have a series on dollarcollapse.com called Who's Next, which looks at the junior miner buyout candidates. And there are some, really successful exploration companies and very small producers that could get bigger in the not too distant future. That are obvious takeout candidates for a Newmont or a Barrick or an Agnico Eagle who might be seeing their reserves drop because they're taking more gold out of the ground than they're finding via their own exploration efforts. So they're going to go out and buy these juniors, and right now they're going to buy them out. The deals that happened this year will be at pretty good prices, 25% over the previous day's close, things like that. That'll be normal. But further down the road, panic buying will start. And you will start to see some really massive multiples over recent valuation for a lot of these companies where, something just starts going up and then it doubles in the space of a couple of weeks because the buyout deal is being leaked and then it gets announced and it goes up a little bit more from there. Things like that will happen pretty regularly in the junior mining space going forward because of all the free cash flow that the big guys are generating. So I think the market is exciting in a lot of ways. So it depends on your perspective, whether you are an income investor. In that case, you want the big guys who are going to generate free cash flow, which they'll use to raise their dividends. Or if you're a speculator like me, you're going to buy up a lot of the junior miners in anticipation of big takeouts in the not too distant future. Either way, fun sector.
What happens to gold and silver if stock markets tank?
Well, that is literally the only really scary thing in precious metals right now. Because if stocks tank, which they're going to do out there somewhere, that'll take down precious metals in the short run. And we've seen that. We saw it in 2008, and we saw it in early 2020 when it happened. Stocks tanked, gold and silver really tanked, and the mining stocks just got crushed briefly. But what happened in each of those times is the governments of the world responded to the stock market crash by just running the printing presses flat out. And gold and silver took off. They had V bottoms in both cases where they crashed and then they shot up. And by a year later, they were way up from where they were before they crashed. So it's not a long-term danger for precious metals miners and precious metals themselves, but it is something to pay attention to and maybe something to guard against a little bit. There are things you can do if you're long gold, silver, and the miners that dig them out of the ground. You can protect yourself a bit with put options on the big miners and maybe put options on stocks in general. If you short the NASDAQ, you're kind of hedging yourself against a stock crash that hits precious metals. So that's a reasonable thing to do. And another reasonable thing to do is hold a little more cash than you might otherwise. You hear me talking about, takeouts at massive multiples. And, you might be tempted to jump in with both feet. Well, now add in the prospect of a stock market crash out there in the future. And maybe you want to hold a little more cash than if you were just listening to the part of the story about all these big takeovers that are coming. And so if you have some cash on hand, these flash crashes that happen periodically in the financial markets in general and in precious metals in particular become nice buying opportunities. So if you have 30% of your investable funds in cash and stocks tank, yes, you lose some money on the stocks that you own, but you also get a chance to jump into some of these things that are going to, quintuple from the bottom of this next crash quickly. So you can make it all back and then some in no time if you play it right. And by playing it right, I mean keep some powder dry. Be ready to jump in next time everybody's panicking.
Are the energy markets causing price inflation?
Oil is up somewhat lately, and there was just a headline today about how Spain is complaining to the EU about high energy prices, but Spain has a lot of alternative energy, which is more expensive in some ways at some times than traditional fossil fuels. Different aspects of the energy market are adding to inflation right now. But I don't think they're the only or the biggest part of inflation we're seeing. Labor costs are up dramatically, at least in the U.S. It's hard to find workers now, in part because of silly government policies and in part because we had a labor shortage before the pandemic hit, and we're kind of just going back to that. There just aren't that many people to do the crappy jobs out there. And because of that, if you want to run a McDonald's or a Walmart, you kind of have to pay up now, and that means wage inflation. In other words, the average wages of your employees might go up by 10 or 15% in a year, which is a big number in the context of the Fed's 2% inflation target, right? So, and we're also seeing resource scarcity, in part due to the supply chains of the world being broken and or kinked up because of the pandemic lockdowns. So there aren't the raw materials necessary or the components necessary to supply a lot of different products like cars. There aren't microchips available to go into all the cars that people would like to buy. So there's a shortage of cars, which means car dealers can charge more, which means the price of cars go up, which is inflation, and so it's like that all over the place out there. We're seeing broad-based inflation because of a lot of different things, and it's not clear how much of it is transitory like the Fed says. In other words, we'll get the microchip shortage sorted out, and then there will be plenty of cars, and car prices will go back down. That's something that might happen. Or whether it's embedded and long-term, which you could blame on all the money that we're creating now. If we're going to pour 40% more cash into the market, that cash is going to buy stuff at higher and higher prices, which gives you inflation. And if we're not going to stop doing that, then we're not going to stop seeing prices go up. And the big governments of the world are showing no signs whatsoever of scaling back their easy money policies. So I think the inflation, some parts of it might fade, but the broader inflation that we're seeing, it's very possible that is with us for the long haul. And when people figure that out, everything changes.
I saw a survey that said people who've been allowed to work at home would rather quit now than go back to the office. And even people in traditional jobs like oil rig workers aren't going back to work because they feel it's unsustainable and they're just going to get laid off again. Is this changing the face of labor?
Yeah, it is. In part because we sent out a lot of checks to people, at least in the U.S., and made it fairly easy to have that attitude. I don't have to work, but as soon as that cash runs out, which it is running out in the U.S., the savings rate went way up during the pandemic and then plunged, and consumer credit is starting to soar in the U.S. It went up more last month than it did since 2007 during the housing bubble. And that's a sign that people are having to borrow to maintain their lifestyles. And, what happens after that is usually that people go back to work. So, yes, it's way nicer to work at home, as you and I know, Jim, right? Than to get up, get a shower, drive an hour in heavy traffic to some office somewhere, and then repeat the process on the way home. It's just way nicer to work at home. And the people who discovered that are reluctant to go back. And plus, then you've got the people who are spooked by the whole COVID thing. They don't think it's over yet. And they don't want to go work in an office. And, of course, you've got the people who have accumulated enough money from government checks that they don't yet feel like they have to go back. That's all going to change, Most of it will go back to somewhat normal when people find out that the only way to pay the bills is to do what they did before.
But before the pandemic, there was already a labor shortage. Restaurants here in Vancouver couldn't find cooks or waiters, so they had to reduce hours of service or days that they were even open. So we had a problem with labor before that. Is this going to give employers more excuse to employ AI and robots?
Well,
or even
right.
a necessity to employ them.
Yeah, there was a labor shortage before. What's happened lately has made it even worse. Although it's worse now than it probably will be in a year, but it'll still be bad. And yes, that's an incentive to automate. Automation is going to happen anyhow because it's just getting better and better. We have burger flipping robots. We have kiosks in a restaurant where you just press some buttons and that's your order. and then somebody just brings it out to you. So you skip the whole waiter part of the process. Same thing with bartenders. There are AIs that can mix your drinks for you, and it goes on and on. Pretty much every industry, including some higher end things like paralegals, which can be replaced with AI now, and diagnosticians in the medical profession. You know, you can input your symptoms and some vital statistics, and an AI will give you a diagnosis that's basically as good as what most doctors will give you. So automation is happening everywhere. You know what, Jim? They will never replace you and me, though, because what we do is too quirky and too hard to automate. But most other people are looking at a risk either immediately or somewhere down the road, and that's absolutely unavoidable. And that's a topic for a future economic crisis. In other words, if the robots that are replacing us are held by just a handful of incredibly rich people, then we need to tax those robots and pay that money out to the people the robots are laying off, right? And that'll be a big political debate, or not, and just let people fend for themselves. There's going to be an argument about that in the future. It's not necessary to have that argument now, but it is necessary to have an argument about the money that's been accumulated and the wealth that's been accumulated by the current crop of aristocrats, right? Should there be people who have more money personally than some countries while paying their workers really crappy wages? Or, should somebody like Jeff Bezos have handed the 30 or so billion new dollars he made in terms of net worth during the pandemic to the people that he was barely paying enough to survive, right? And that's going to be an argument that will really light up politics. It's going to be a really interesting argument in the future. It could be just the very next election when this starts, because I think Donald Trump and Bernie Sanders in the U.S. made it clear that there's a market for populism in politics. So it just depends on whether a really likable, articulate, energetic version of one of those guys comes along and starts stirring things up. And I think it's inevitable that somebody does, whether it's this next presidential election in the U.S. or whether it's further down the road. We'll have to see. But that's our political future one way or another.
Agenda 2030, the Great Reset, is the world going back into lockdown? Maybe. There's a lot of inching towards new lockdowns, and there's a lot of pushback. So this is yet to be seen if they're able to impose a new lockdown on everybody. Because you're seeing they had to put the army on the streets in Australia, right? Because the Australians were having none of this new lockdown stuff. And there are pitched battles between French people and German people and their respective cops in the streets of Paris and Berlin right now. So the aristocracy might see another lockdown as a way to squeeze the last bit of wealth out of us. In other words, accelerate the process of taking our houses away or buying up all our farmland, so that when the time comes, we're basically living in a company town, renting our house from the company, buying our food from the company at their prices, on their terms, and we're basically debt slaves. So it could be that they see that as part of their long-term plan, and it could be that people are just done with it, that Florida and Texas are the future, where there are no lockdowns, there are no mask mandates, and it is literally illegal to try to impose them at the business level or the city level. So we'll see. Very interesting political dynamic going forward, and you know who I'm voting for. I'm wholeheartedly on the Texas-Florida side of this argument. He just posted an article entitled, "Creeping Fascism is no longer creeping." What are you referring to?
The stuff we just talked about. There's a lot of things going on now that are just so blatant. And, in Germany, they made it illegal to gather. And they're aiming that at anti-lockdown protests while they're allowing other gatherings to take place. There was this big, I don't remember what it was exactly, but there's a picture in the article that I posted that is just people as far as the eye can see. And that was allowed in Germany. But if you want to get 30 or 40 people on the street to protest lockdowns, they're using that law to bust you. And in Australia, they sent the army out into the streets. You know, it's going on like that. And I think that people are fighting back against it at the same time that governments are. And a couple of other ones. I'm sorry, I forgot. There's a couple of other almost amusing stories here that are along the same lines, where Apple banned the dating site for the unvaxxed. In other words, it was a way for people without vaccination to communicate and meet up, and Apple said that was a violation of community standards, because it was treating the COVID pandemic in a unserious way. Meanwhile, Instagram censored a post that was a historical look-back thing. It was one of those 100 years ago today posts that mentioned in a really neutral way that 100 years ago, Hitler was elected to head the National Socialist Party, the Nazis. And Instagram censored that because apparently a picture of Hitler is triggering. So you've got all these weird, strange kinds of impositions on what we thought were our basic freedoms taking place just out there in public now. It's not, it used to be creeping fascism, where they had to kind of do it in secret. They had to call it by a different name. And they had to really demonize the people who disagreed with it. Now they're just doing it. They don't even care anymore. So, I think we might have to start calling it galloping fascism if something doesn't change soon.
What does the expiration of the eviction moratorium mean for the U.S.?
Well, it's not clear because they're going back and forth about what it's going to be. Originally it was, okay, we during the COVID lockdowns, nobody was allowed to be evicted by their landlord. And then they were just going to let that lapse so that people had once again to start paying their rent and everything, which, by the way, goes back to our conversation about people not wanting to work. Part of it was that they didn't have to pay their mortgages or their rent. Well, now they're going to have to. Although Biden faced a lot of pressure over that, and he's apparently trying to extend it in some circumstances for some people, and it's not clear yet exactly what it's going to be. So we don't know exactly what it means. If it's everybody all at once having to pay their rent again, presumably a fair number won't be able to, and there will be a lot of evictions. Now, remember, Wall Street loves that because then they can swoop in and take over that part of the housing market. But on the other hand, maybe Wall Street doesn't love it because they're already the biggest landlord in the country, and maybe, a lot of their houses will, whatever. We don't know. It would be very bad for the short-term growth of the economy if 10 million people got evicted. But I suspect that's not going to happen under any circumstances. But if it did, it would be a fairly big deal.
You published something about a Silicon Valley bubble. Is this a replay of the .com bubble and crash back in 2000?
Oh, yeah, that's what we talked about before. Sorry, I probably shouldn't have brought that up right away. But, yeah, a lot of Silicon Valley or a lot of Wall Street companies are jumping into Silicon Valley venture capital without having the faintest idea how illiquid assets work, I think. A lot of these guys, like pension funds, they're used to being able to trade what they own mostly. In other words, stocks and bonds. That if they need to get out of it, they can get out of it. If you buy into a Silicon Valley startup and it doesn't work out, you can't just sell the thing. You go in there and you have to negotiate and you have to watch the thing just collapse in value right before your eyes. And I don't know how completely, especially pension funds, understand the illiquidity of something like that. But they'll find out, in the next stock market crash, that's probably going to be one of the big stories. Oh, this hedge fund blew up because it owned $1 billion worth of this startup that is now worth nothing because the business model was always flawed, but nobody saw it in the heat of the bubble. That kind of story it's going to be everywhere. And then the federal government will have to decide whether to bail out the hedge funds and the pension funds. And of course they will. And of course they'll dump all that debt onto taxpayers. And of course at some point that will hit the value of the dollar. So we'll have a giant currency crisis after some bailout sometime. And this could be the one.
Could we see a spike in mortgage rates caused by the bond market?
Yeah, maybe. Interest rates spiked earlier this year. And it looked like that trend might have legs, but then it turned right back around and interest rates are tanking now, which kind of implies either central banks are secretly slamming bond prices down or secretly buying up more bonds than everybody thinks and then pushing yields down, or the bond market is implying that the economy's much weaker than we thought. So we'll see. But I think at some point, rising inflation will lead to weaker currencies, which will lead to higher interest rates, which will smash the bond market, and that'll lead to higher mortgage rates. So yeah, there's a dynamic out there that can lead to much higher mortgage rates, but it's not today. Right now, mortgage rates are at not far from record lows, which underpins the stock or the housing market a bit, but only a bit, because prices, it doesn't matter what mortgage rates are now if half the people in the country can't afford to buy a house. And, they get a slightly better deal on the mortgage, which lets them buy slightly more house, but if the average house is 50% above their buying power, it doesn't do them much good. And I think that's where we are in a lot of cases now. So the housing market could roll over at any time in the U.S. It's vastly overvalued, and in a normal world, it already would have crashed. But we'll see how abnormal this world is going forward.
Are electric vehicle manufacturers running into supply shortages of materials needed to produce lithium-ion batteries?
Yeah, the lithium thing is a big deal because it's not just lithium, but that's one of the bottlenecks, and cobalt is another one, and nickel is another one. So what you want to do in a situation where an industry is slated for massive growth, but there are supply bottlenecks that get in the way of that, you want to buy the resources that they need. So, you know what? Nickel mines, cobalt mines, those are really interesting investments right now. So if they have a correction, that would be something that you want to jump into, because electric cars are a done deal. They're totally going to take over the automobile market. And because of that, they have to have the ingredients that go into electric cars. Now, the one risk, I think, to that scenario is that lithium-ion batteries aren't the only way to power an electric car. You can do it with fuel cells, which run on hydrogen. So that's a different supply chain there that might be interesting at some point. If you if you put solar panels on your garage and have a machine in your garage that makes hydrogen, then you just fuel your fuel cell car in your garage in the morning with hydrogen, and you just go out and drive it. And so the guys who make that gear might also be really good investments going forward. So it's a fascinating time for new industries. And if everything wasn't so overvalued, I'd be really optimistic about growth stocks. But they have to crash before they become interesting, I'm afraid. You're just going to need to see this market tank. And then at that point, give us a 60% drop in the broad market averages, and there will be some really spectacular little growth stocks in electric vehicles and their components and their raw materials and in the hydrogen economy, stuff like that. It's going to be amazing, but not till then. Wait for the crash before you buy these things.
Where do you put your money when you want to keep it safe?
Okay, safe, I think, is the operative word right now. You should not be going for massive capital gains in the industrial economy right now, with the exception of precious metals miners. And even there, speculations, for reasons that we already discussed. Most of what you should be doing with your money, or actually that's too strong. most of what I'm doing with my money is focusing on return of capital rather than return on capital. That means owning real money like gold and silver, and maybe some real estate that is highly likely to hold its value. In other words, non-leveraged real estate in a place with a fairly stable economy. Things like that, which will probably be worth about the same in terms of purchasing power 10 years from now that they are now. That's what you want to own in inflationary periods and unstable periods like today. Because everything else can go down by 50 or 60 or 7% very easily just based on market forces. And I'm talking about bank stocks and home builder stocks and big tech and electric car companies, things like that. Just, all those industries will probably do fine in the long run, but their stocks can just collapse from here. So don't be involved in that. Do be involved mostly in things that will hold their value over long periods of time. And gold and silver have done that for, well, at least 3,000 years and maybe 5,000 years, depending on which historian that you're reading right now. And everything human stupidity has been able to throw at them over 3,000 to 5,000 years. They've come through it just fine. They've stayed valuable through every kind of a crisis you can imagine. So highly likely that they will stay valuable this time around. And then cryptos they're a tougher story because are cryptos growth stocks or are they money? We don't know yet. And because of that, they're very volatile. But owning a few cryptocurrencies, especially Bitcoin, maybe Ethereum, might be a way to diversify your hard asset portfolio.
What sectors are you looking at and investing in right now?
Well, as far as investing goes, owning money is not investing. Gold and silver are not investments. They are cash. So that is not an investment. That's just your money that you're putting away for tough times. The sector I like best, as I said, is gold and silver miners. They are just fundamentally great, and they've got great futures and everything. So other than that one crash possibility, when the rest of the market pulls them down, I don't see any real headwinds for the gold and silver miners. I think that they will be fundamentally strong investments with rising dividends and/or good takeover prospects for as far as the eye could see.
John, where can people find out more about dollarcollapse.com?
Well, I run dollarcollapse.com, and go there, join the mailing list by clicking on the button at the top of the page, and I'll just send you whatever I write going forward. And we don't use your information for anything else but that.
John, thank you so much for being back on This Week in Money.
Thanks, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. And that wraps up our show for this week. We'd like to thank our guests, Bob Hoye and John Rubino, and thank you for listening. If you have any questions for the show or our guests, you can send them to info@howestreet.com. Now stand by for a company showcase update from American Manganese President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Well, thank you, Jim.
Larry, we're looking at infrastructure programs in the U.S. Are they aimed at increasing the use of electric vehicles, and how would that affect your company if they are?
Well, of course, the more electric vehicles means more batteries, which means more to recycle, more scraps. All those things are good for us. They've announced an ambitious, which I call a super ambitious, program of having 50% of all vehicles either powered by electric by, basically lithium-ion batteries, or plug-in hybrid electric, or fuel cell. And so I'd say that probably at least 40% of that would be lithium-ion batteries. Now, I have some comments to make about that because he will sign the executive order at some time here in the near future, and but they've announced it, and that pretty much is what everybody's thinking about today. But, there's pros and cons for that, and the pro is we love it. We love that sort of an attitude. And but the cons is it attainable? Even if it was only 20% attainable, I think that would be a tremendous boost to the electric vehicle business and to the recycling business. And so and the reason I say that is for several reasons. One mostly being where are you going to get the supply of the metals that are needed in these new batteries? And that's something that everybody's fighting over right now, is where they can get a supply of the cathode materials. And it basically comes down to China. They pretty much have that cornered. And, and then the very root reason for having these metals is right now is mining. And with all the permitting problems and everything else that go on, that's a slow process. And but you have to mine the material in order to get it out there and into the mainstream, where it can get into a cathode manufacturer's hands, and then into a battery manufacturer, then into an EV car. So where is that going to come from? I mean, that's a question that is being asked all the time. It's not just me. And, so right now it seems inadequate to try to produce, 50% of the new cars in the U.S. by 2030 as electric vehicles or related to electric vehicles or clean technologies. Anyway, I see that as kind of the major hindering of getting that ambition completed. I'd like to see at least 20-25% of that reached. That would be tremendous for us. I noticed that they didn't talk anything about recycling, but the recycling is one way to get the materials back into the mainstream. But batteries are having a longer life, probably averaging 10 years now. So, there's not going to be that many batteries to recycle for at least another 10, maybe as high as 12, 15 years. And so we're focused on scraps. As long as they're manufacturing batteries, there's going to be scraps. That averages about 10%. And, that's kind of what our whole business model is based around. We can certainly do black mass, but right now we're looking at the scrap material because that's where we've developed our technologies, but they also work on the black mass, and so it's a win-win for us. So anyway, as usual, with great news like this on the horizon and coming out, we went down. Everybody else went up, but I wonder why we went down. Maybe it's got something to do with that guy that literally posts everything that we don't do on the boards and nothing about what we've accomplished. And, that's a biased opinion, and I don't believe him to be a shareholder. So, be careful listening to that guy's advice. He's got another agenda, which you all know about. And, so a shareholder wouldn't go out there and bash the stock and the management the way he does. But anyway, I'm off track there a little bit, but I had to mention that because, we've seen the stock, ease down and, at a time when, it should be more active and easing up. And, but anyway, my opinions are my opinions only. And, if we can get a 20% boost in the amount of EV cars, then that is excellent for our business model. And, 50% would be over the top. But I don't know how you're going to get, like I just mentioned, all the battery metals that you need, such as lithium, cobalt, nickel, and manganese for that matter. But because the U.S. has no production or very little production of any of that, and so it's where are you going to get it from? Everybody's fighting over it. Everybody's talking to Glencore. Everybody's ending up in the DRC, and so it's a mishmash out there. Everybody fighting for space. You've got to have those metals in the batteries, or else you're out of business. And there's other batteries that are being basically being proposed, like sodium and iron phosphate, and all those ones that have very little value on recycling. Well, that may be cheaper for the battery manufacturer in the beginning, but somebody's got to pay for it in the end, and if they want it recycled, it's going to cost them money to get it recycled, and it'll have to be a negotiated price, and then the recycler has to make a little bit of money, or else he's not in business. So that's kind of what we see, and we also noted that the UAW didn't invite Tesla or Elon Musk to their opening on this $50 million, 50% raise in the next 9 years in the production of batteries. So there was Tesla was notable by their absence, and Elon Musk, he's the biggest producer of EV cars in the United States. You think he'd have been there, but Tesla was omitted from the invitations for political reasons, I guess, and that's unfortunate, because I don't think there would be even talk about an EV business or batteries or recycling or any of that if it wasn't for Elon. He pioneered it, and he brought it to the forefront and attracted a lot of other Me Too's, and some of them are, getting fairly successful. So that's a big omission. I don't like to see that. He's a pioneer, and he should have at least been in the lineup with the other groups like Ford and GM. Now, Ford and GM say they want to meet that criteria and go to 40 or 50% production of EVs from all of their plants, and my hat's off to them. But again, the question comes up, where are you going to get the metals to build the batteries? So, it's all related, and, any kind of a push in that direction, as far as I'm concerned, is very positive for people that are in the EV car stream, and we definitely are. And but we strive to get, a total circular economy with nothing going back into the environment. And, until we do the testing, maybe then people will believe us on that 600 kilogram a day or 500 kilogram a day plant. And, so we're moving ahead in that direction. So, but, other than that, Jim, it's not been that, it's been a fairly great time. And, I just have to say that, these changes on the landscape are positive, and we have to be realistic about them. And as the CEO of a company, I have to take a realistic look at what's going on, and because it's all about the environment. And then, secondly, and of course, it should be just right up there in a straight line with the environment, is what is the profit going to be? A lot of articles are out there saying there's no profit in recycling. I think nothing could be further from the truth, and we just have to impact that out there with what we're doing. And when we finally get to a stage of the design and the cost of the 5-ton-a-day plant, then we can project some realistic figures. But, we projected figures earlier. I don't think we were much off of those. And, and I think that we're in the right stream, and the shareholders should be proud of the company. So, I think that's about all I can say about that, Jim.
Larry, for people new to American Manganese, what's the company all about?
The company is a critical metals company that developed a patented process for the treatment of very low grades of manganese in the U.S., which the U.S. needs, and we have a contract with the Department of Defense. We're getting down to the final results in that contract, and that's to do with manganese and the electrolytic manganese metal. And from that technology was the cornerstone of our technology for recycling. And, that's basically where we're at today. We've proven on the bench scale and pilot tests that we can get up to 100% recoveries and purities. And so we believe ourselves to be on the right track, and I think people will be surprised at the amount of money that could be made by a recycling company that is doing things the way we're doing it. Now, you can get all this information off of our website, AmericanManganeseInc.com. We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. on the QB board under the symbol AMYZF, and we're traded in Frankfurt under the symbol 2AM. You can contact the company by going to the website, or you can email me at LREAUGH@AMYMN.com, or give us a call here at 778-574-4444.
Larry, thank you so much for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on August 6th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.